Markets are actively pricing in the end of a major European war. It's happening fast, following the progress on the Ukraine peace deal.
You can see it across the board.
Absolutely.
Yeah.
Yet gold, which should be falling off a cliff, is aggressively refusing to drop from its range near that $4,330 all-time high.
That's a profound disconnect, a critical one.
It is. It signals that the smart money, the sophisticated investors, they don't see this peace as stability,
What do they see it as?
an official commitment to U.S. isolationism, and, frankly, unchecked global fiscal expansion.
This is Neural Pulse. Let's analyze.
We have an unprecedented confluence of events hitting our desks this week.
Right. So our mission here is to really understand the structural changes from this U.S. strategic pivot. We're talking about the sudden Ukraine exit happening almost at the same time as that bold intervention in Venezuela.
And then interpret the immediate financial and, of course, the cybersecurity implications.
Let's unpack the facts of the geopolitical pivot first, because the sequencing, the timing here is everything.
The facts on the ground are solid. The Mar-a-Lago meeting between President Trump and President Zelensky, it confirmed the final stages of the ceasefire negotiation.
And the statements afterwards were decisive.
Very. Zelensky noted, and I'm quoting here, 100% agreement on the security guarantees. He also said that 90% of the overall peace plan was done. It's moving toward implementation now.
Okay, that's piece number one. But we can't look at this pivot away from Europe in a vacuum. You have to link it directly to the kinetic action that happened just 2 days before.
In the Western Hemisphere.
The successful detention of Venezuelan President Maduro on January 3rd, Operation Southern Spear. What's the strategic calculus that connects those two?
Well, the interpretation from our sources is clear. The United States just cannot logistically or financially sustain three major active fronts at the same time.
Three fronts being?
Europe, with the massive aid in proxy warfare, the Middle East, which is always volatile, and now this new, very active front in the Western Hemisphere and the Indo-Pacific. It's just not possible.
So they're executing what our reports are calling a frontline consolidation.
That's the key phrase, consolidation. It's a necessary and very calculated strategy.
So the U.S. is dramatically cutting its commitment in Europe, which was a huge fiscal drain, to concentrate those finite resources on what they now see as the real priorities.
Which are resource control in the Western Hemisphere and, of course, containing China in the Indo-Pacific.
And the speed of Operation Southern Spear. That's the tell, isn't it?
It's a huge clue. It wasn't just a political statement. It was a major deployment. The scale and complexity of that operation required weeks of concentrated resources, manpower, intelligence.
And that commitment had to be balanced by a reduction somewhere else.
It had to be.
Okay, that context explains the speed, but it doesn't solve that market paradox in Europe. If peace is breaking out, defense stocks should be dropping, the euro should be strengthening.
And we should see stability returning.
But instead, we're seeing defense stocks and the euro just fluctuating wildly. What are investors seeing?
They're reading the fine print of the exit.
Oh.
The market views these new U.S. security guarantees for Ukraine as unlikely to contain an automatic NATO Article 5 style commitment.
So the U.S. is basically saying, you're secured, but you're on your own now.
That's it, precisely. This pivot forces EU nations, especially NATO members, to shoulder their own massive accelerated rearmament costs.
But doesn't the U.S. realize that's going to create incredible pressure on the European Central Bank, the ECB, all of this new sovereign defense debt?
Oh, that pressure is the feature, not the bug. The source material argues the U.S. is perfectly comfortable with that consequence.
Why?
Because the ECB will be forced to prioritize buying those new defense bonds. They'll have to monetize that debt, which pushes inflation control way down the priority list.
And that fundamentally damages the euro's long-term value.
It does, because the U.S. is signaling it will no longer guarantee Europe's security or its fiscal discipline. It's forcing Europe to grow up fast or collapse.
So if these security guarantees are now seen as conditional, at best, the whole global monetary system is under pressure. The withdrawal of U.S. security, the breakdown of fiscal discipline, it all translates into how the world sees the dollar, right?
What does that distrust look like in dollars and cents?
Yeah.
It looks exactly like the gold market. I mean, despite this huge geopolitical de-escalation in Ukraine, gold is cemented around $4,330 an ounce. It shows zero sign of falling.
This isn't just stability. It's an aggressive refusal to correct.
And the institutional forecasts, they confirm this structural view. We're talking JP Morgan, UBS. They're anticipating gold hitting $5,000 by Q4 2026.
Now, potentially $6,000 long term.
Which is a staggering prediction in what's supposed to be a post-war environment.
Let's slow down here because this is the most fascinating part. The driver isn't the classic fear of war.
No. It's an absolute structural distrust in currency.
The U.S. policy bundled domestic tax cuts, new tariffs, and now the military spending hike for South America, it all guarantees massive, non-shrinking U.S. deficits.
And that leads us to this critical historical deviation. Gold is a non-yielding asset. It should be unattractive when real interest rates are positive.
And right now, the 10-year Treasury yield is holding steady at 4.17%.
Exactly. Historically, high real rates crush gold demand. You can get guaranteed returns somewhere else.
But that's just not happening. Gold is still being bought aggressively. For the listener managing their portfolio, what does it genuinely signal when the normal rules just don't apply anymore?
It signals one of two things, and both are critical. Either investors believe that current interest rates, no matter how high they are, just can't suppress the structural inflation that's now baked in. Or, and this is far more worrying, they view U.S. Treasury debt itself as having taken on political and systemic risk. They see the dollar as weaponized, and they don't think monetary policy can fix that loss of trust.
And you see that amplified by the sustained central bank buying.
It's incredible. China, Russia, the Global South, they're buying an average of 585 tons per quarter. This isn't just portfolio management.
It's a permanent defensive strategy.
A strategy against the weaponization of the dollar. And a limited peace deal in Ukraine is not going to halt that de-dollarization effort.
And this flight to fiscal independence isn't just physical gold, is it?
Not at all. The lessons from sanctions, from asset freezes, like the swift Maduro asset freeze in Venezuela, are driving a clear correlation with censorship-resistant assets like Bitcoin.
They're becoming a standard risk hedge for states, for high net worth individuals, anyone who wants wealth outside the reach of a political decree.
That fight for fiscal independence, for resource hedging, it takes us away from the financial desk and directly to the raw materials conflict now hardening on the African continent.
Right, an area that is rapidly filling the geopolitical vacuum left by that U.S. pivot.
So we shift our focus to the Sahel. This is a very specific resource-driven retaliation. The Niger military regime has now confirmed it. They've seized the uranium mining interests.
The ones held by the French state-owned company, Orano.
Correct, and they've declared they will now conduct independent sales directly to the international market.
And on top of that, the Hell States Alliance, the AES, so Niger, Mali, Burkina Faso, they've deepen their defense cooperation. This is really a resource protection pact.
It is, and it's relying heavily on Russian-aligned private military companies for security.
So this whole move is fortification.
Pure fortification. Our sources suggest it's driven by acute security anxiety among those AES nations right after the U.S. intervention in Venezuela.
They saw the U.S. move against Maduro and thought, we could be next.
Correctly. They concluded their resource-rich, politically sensitive regimes could be next on the consolidation list.
Okay, that explains the timing, but let me push back a bit. The interpretation is that they've just swapped one master, France, for another, Russia and China. But from their perspective, isn't this a real act of sovereignty?
They are certainly claiming sovereignty, but the paradox is acute. They rejected financial and military dependence on France only to immediately deepen their reliance on Russia for security and military tech.
And on China for sales routes.
For technology and reliable sales routes, yes. So they've achieved resource control, but at the cost of a brand new geopolitical allegiance.
And domestically, they're facing huge inflation pressures because of this, aren't they?
Absolutely. The global oil price volatility plus the new trade routes they need, it's severely increasing transport costs for these landlocked nations.
And that cost translates directly into food inflation, domestic instability.
Which forces the regimes to lean even harder on their new Russian security partners. It's a cycle.
The consequence for the West is now locked in. The supply disruption to French and European nuclear energy is a fixed factor. Uranium prices will keep rising.
Which just intensifies the scramble for alternative sourcing in more expensive but stable places like Kazakhstan, Canada, Australia.
So the Sahel is now functionally a Russian and Chinese resource hub, inaccessible to Western influence.
So while the U.S. military pivots to the Pacific and Latin America, adversaries are capitalizing on the non-kinetic battle space, the unseen asymmetric battlefield.
Which brings us to the invisible war. What's the latest actionable intelligence on the response to the Venezuelan operation?
The finding is alarming, and it's confirmed. Reports from CISA, the Cybersecurity and Infrastructure Security Agency, reaffirm that the Chinese state-sponsored group, Volt Typhoon, has penetrated and achieved pre-positioning.
Pre-positioning deep inside U.S. critical infrastructure.
Deep inside. We are talking about confirmed access to power grids, communication towers, water facilities, and port systems across the continental U.S.
And their technique, living off the land, or LOTL. We should explain that. This isn't custom malware we're talking about, is it?
No, not at all. LOTL means the attackers are using existing, legitimate, trusted network tools. Tools the system administrator already uses every day.
So it's like a burglar using the building's own keys.
That's a perfect analogy. It makes them incredibly hard to detect. They can remain virtually invisible inside these sensitive operational environments.
And this pre-positioning, it serves a very clear strategic purpose. It's deterrence.
Right. China feels forced to display its asymmetric retaliation capability after the U.S. used force in Venezuela. They're basically holding U.S. mainland infrastructure hostage to curb any more military action regarding Taiwan or the South China Sea.
This means China's reaction to the Maduro detention could go way beyond just a diplomatic protest.
The risk of sporadic system failures, unexplained outages in U.S. power grids or ports, it's now significantly higher. These would be tactical warning shots in cyberspace.
A way of saying we see you and we can touch you.
Precisely.
This demands immediate corporate action. Companies have to raise their cybersecurity posture to maximum right after a geopolitical trigger like this. The focus of these attacks has fundamentally shifted.
We're not talking about stealing credit cards anymore.
No, we're talking about turning off the lights in a port terminal, shutting down water facilities. The goal is physical operational stoppage.
And this is the most critical, actionable insight from our sources. The damage from this prepositioning. If it leads to an operational failure, it's increasingly likely to be categorized by legal and political bodies as an act of war.
Why does that matter to a corporation?
Because your standard corporate insurance policy almost certainly contains a war exclusion.
So if your insurer successfully argues this was a military act by a foreign state,
your multi-billion-dollar business interruption claim could be entirely invalidated. The cost of this invisible war will fall directly onto the private sector unless they act now.
So if we connect this all back to where we started, the Ukraine exit enabling the Venezuela operation, the core thesis holds. The world didn't find peace.
The battlefield just relocated. The U.S. prioritized its direct resource and strategic interests by concluding its costly proxy war in Ukraine.
Okay, so 3 core takeaways. First, do not trade on peace. The Ukraine deal signals U.S. isolationism. It justifies high gold prices because the currency distrust is structural.
Second, beware of energy dips. That post-Venezuela price correction is temporary. The geopolitical risk in the Middle East and Taiwan means $100 plus oil spikes are easily repeatable.
And third, fear the cyber silence. When the U.S. uses kinetic force, adversaries prepare for invisible retaliation. Assume any unexplained infrastructure failure in the coming weeks is an attack, not a malfunction.
The era of assumed peacetime is officially over. We are in the preparation period for the next phase of conflict.
Neural pulse, clarity in a complex world. See you tomorrow.